What is up, traders? My name is Heath and this is Trade Talk. Today we'll be looking at Bitcoin. Last Saturday I laid out a bullish trade for Bitcoin and the target has been achieved. In this video I will be laying out how one could have taken the trade. The first target was taken from the 8-hour chart. The open price of the last 8-hour bullish candle is considered to be a supply zone. When we breached and closed above a very important daily resistance level of $40,623.33, we then had a bullish bias. As we never ever chase price, we must wait for price to form a higher low support, preferably on the daily. In this case, it was formed on the smaller time frame. We seen support hold at an hour demand zone at $37,810. Once price left this area with haste, closing bullish candle after bullish candle on an hourly time frame, we know that price left the area aggressively, so if price comes back into that area, we can then wait like a sniper for the perfect entry. Also, when price broke out above the hourly resistance, it never retested that area, so this means that it can and sometimes will come back for that retest. Patience and self-control are two very important characteristics individuals need to have to be successful in this game. So as we wait, we are looking to see if price is holding support. Support is held upon closes, so each hourly candle trades down past the support but closes above the support zone. Even though the last 10 hours of price appear to be bearish, we know on the larger time frames such as the daily, we are bullish. And now it is time for us to go to work. The hourly demand zone, aka Heath level, is here at $37,810. As you can see, price formed an objective support at $37,986.31, an old hourly resistance. But the main price we are watching as an hourly close below it tells us we will likely be wrong if we proceed, and that price is hourly demand at $37,810. Also, I want you to notice what time this is occurring. It just happens to be at the New York Open. If you are familiar with my channel, you know that this time of the day is the last of the 3 key opens and the most of the volume gets thrown down at these times. So, at 8 a.m. Eastern Standard Time, we had a run below the last swing low. But where did that candle close? You got it, above support. When this occurs, we start looking for entries. And at this point, there are several ways in which you can define your rules for your entries. A midpoint test, for example, or a retest of the actual demand price. One of the safest ways is to wait until the stop run candle's high gets taken out and your stop would go below the low of that candle as well. The reason for this is because if price goes back down to those lows, then it is continuation and not a stop run. So that's a good place to exit your position by a forced stop loss. In this particular case, with that entry and stop, your risk to reward was a 5-to-1. It's a good idea to never ever risk more than 1% of your account's total equity while you're still learning and honing your edge. Even though this is a simplistic way to trade, it is very, very advanced and requires much patience. The one attribute that many lack when trying to learn this skill. My job is to teach you the way in which I see the markets and the way that I analyze the markets. It is and will always be up to you, the individual, to learn this and practice good risk mitigating principles to ensure that you are able to stick around long enough to learn it. This will give you a better chance at becoming successful in the long run. And make no mistakes, it will be a very long run. So with all that being said, make sure you hit the like button, make sure you subscribe. Until next time, trade safe, trade smart, and happy trading.